that you'll find throughout the semester, okay? Did I say that before? I guess, okay. Basically what happens is when governments go out and borrow money, let's say you go borrow $10 million to build a building. The people who lend you the money want to make sure that you use it for the purpose that you borrowed the money for. So what they ask you to do is, and governments like to do this too, is they set up a little fund for construction of that building. A self-contained fund has its own assets, its own liabilities on a modified accrual basis. So the building starts off, so what's the first thing that happens? They go out, borrow money, $10 million, right? $10 million is transferred into the capital projects fund to get the project started. They sign the contract with the builder, with the architect, with all these folks. Encumbrance accounting is now used. A budget is used because this is what? A governmental fund. So you now do that. Once and while the building is being built, you record all the expenditures as construction work in progress. So you can, it's like a little bucket which is holding these costs as you go along. Once the building is completed, capital projects fund is closed. And the asset is what? Transferred under the full accrual basis to the government-wide statement of net position. And that's what we'll see right now. Very simple cycle of transactions, but two types of capital projects: general, those which benefit everyone, and these benefit only a few. What's the difference? This is paid by all the taxpayers, and this is paid by what? Those who benefit from that improvement. That's why it's called what? Special assessment. I want you to take a look at this because the first thing I want you to remember is that even though the words used are capital projects fund, if I ever ask you, do you show capital assets in capital projects fund, what would your answer be? No. You only show them as being built, but never when they're completed. Once the asset is completed, the account is closed, and you transfer the asset out. Okay? So they are long-lived assets, meaning not little things, but big things here. Usually involve a construction project. They have long-range planning, financing, project life focus rather than year to year. So a project can be done over several years, and it has that focus of that. Okay, and these are some of the things that you should take a look at. With long-term financing, usually you have to go out and get, through a referendum, the ability to raise money because it's the taxpayers who are going to pay for it. Okay. These are the general entries, and we'll just go through this cycle quickly here because there are lots of them here, but I want you to just see what happens. So they have started a office building project. And one of the reasons they started doing this was they're going to get some money from the federal government. Sometimes federal government, state government might give you money and say, look, you borrow $9 million, we'll give you $1 million. Well, this money came in from the federal government. It's coming in. They've got a commitment, so they recognize this as a receivable and as a revenue. Money coming into the capital projects fund. This entry is not very different, just the item is called differently. Program revenues under the full accrual basis. Okay. They're getting a loan from the general fund for $50,000 instead of just a cash infusion. If it were just from general fund without any obligation to pay, it would just show up as other financing source. And then you ask me, but wait a minute, we always thought that we didn't record liabilities. But you know what? This is interim financing and short-term loan. So if it's a short-term loan within a year, which has to be repaid, you can record that. And this is the problem that people have with some of this stuff. They say, on the one hand, you tell me you cannot record it, then you tell me record it as a payable. Well, because it's short-term interim financing. Short-term stuff you can record, not long-term. Anyone tell me no entry needed? Why? Why no entry needed? Didn't we just borrow money? Okay, let me ask you a question. Capital Projects Fund. What is it a part of? Governmental funds, right? The government-wide statement has governmental activities and business type activities. Does it differentiate between the different funds within the governmental funds? No. It's like this. You have a family of 5. You prepare a balance sheet, a family balance sheet for publication outside. Any amounts that are due and paying within the family members, do you care? No. If you prepared it internally for each person, you would care. But if it's for the entire family, it isn't. And that's what with governmental funds, that's why we don't record them, because what we have here is within the funds themselves, within the governmental funds. If it were from, would you have to record it if it was from the business activity to the governmental funds? Yes, because that's what? It's outside the governmental funds. Here's a contract that's signed. Usually what's one of the first steps that is taken with when you purchase items or when you commit items to items in the governmental? You set up what? Encumbrance. We talked about that last time. Always you set up an encumbrance, but under the full accrual basis, we don't recognize encumbrances at all. Again, this is from the last time. They go ahead and pay the bill. The encumbrance was for $50,000. It only cost $48,000. You reverse the encumbrance, these 2 entries, and you show the actual expenditure here. Construction work in progress is shown here under the full accrual basis. And let me just, I'm going through this quickly. I'll try to explain to you the pieces that are really important. Okay. Remember I told you that when you issue bonds, you issue them at face value. Hopefully you raise $5 million, you borrow $5 million. What you get back is dependent on what rate you're going to pay on those bonds. They can be sold at a premium or at a discount. In this case, what happened? The bonds were sold at a premium. So all they needed was $5 million. What did they get? $5,050,000. But notice what happens. The smart accountant said, just because you got $5,050,000 doesn't mean that it's yours. 50 of that should go to the debt service fund to pay off the loan. Okay? And that's what you see here. And here it's premium on bonds payable because that's how we recognize that transaction. And again, you get the money from the federal government, so you reverse the entry that you had made previously. Interfund loans payable, you pay the general fund back, so there's that entry being reversed. Again, contract was signed. Anytime you sign a contract, what do? The first thing, you create an encumbrance. And the entry is always the same, debit encumbrance and credit encumbrance outstanding. No activity, nothing in the governmental activities area. Everybody with me, stop me. I see some glazed eyes. You need some coffee. We'll take a break shortly. Okay. You know, I don't know if you heard, but they did a study. I'm sure everyone's heard this. High school students, that it would be best if the classes started later. You've all heard that, right? And I guess it's just not high school students, it's also us. And for me, I'm really suffering because I'm 3 hours back, you know. So, you know, it's more like when I got up, more like 3 o'clock in the morning. Okay. So I have to keep on going. So if I fall over, you know, pick me up. Okay. So here's the construction expenditures. You recognize it. Again, the way to remember this is the basics. With governmental expenditures, usually there's an encumbrance. When you pay the item, you reverse the encumbrance, and then you record the transaction. Notice, instead of construction expenditures, you have construction work in progress, because there is no expenditures in the full accrual basis. This is what? An asset account, construction work in progress. This is not an asset account. This is expenditures. Okay, now another thing. Let me just explain this to you. Governments don't trust contractors to do things right. So what they do is they withhold a portion of the payment. So in this case, it's 5%. Contractor presents an invoice for $100,000. What do they pay them? $95,000. Contractor says, not fair. They say, look, when you complete the project, and if we are satisfied with it, we'll give you that $5,000. What's that account called? Contracts payable retainage percentage. If it has a credit balance, what kind of an account is it? A liability account. Because you're going to eventually pay it. It's just that you're holding. Why do governments do this? If they find a problem, they rather not go sue. They rather use that money to fix things and then give them. It happens all the time with large-scale contracts. What was one of the largest construction projects recently undertaken? Yes? How about in this part of the country, Northeast? Big project, one of the biggest projects. That's it. What was it? The Boston dig, the big dig. What was it estimated at? 6 or 9 billion, went up to $14 billion. Okay, one of the largest construction projects, which, you know, is an example here. Okay, but this is, can you imagine people arguing about this there, right? So this is a retainage percentage, and eventually they'll repay that 150, which we have. Again, they recognize the item as it's being spent. Next payment comes due. They withhold again 5%, 100,000. So now what is it? 150 plus 100, 250 they owe this fella. Okay. It had to be more than 250 because they withheld 75,000. And notice this, the cash was paid and now the contract can be closed out. This is the final entry to close all accounts. So let's try to read this. When you close accounts, what kind of entry do you make to the account? Exactly the opposite. If you close a revenue account, what would you do to it? You would debit it. If you close an expenditure account which has a debit balance, what would you do to it? Credit it. And this is what we're doing. Other financing source, $5 million, which was shown originally as a credit, we debit that. Revenues, which were originally shown as a credit, is now shown as a debit. Construction expenditures, $5,048,000. Governments always like to see budgets, what's the word? On time and under budget. Those are the two magical words. If you hear that, you're happy. On time and under budget. Well, it looks like they did okay, because they had what? $52,000, which remains. What are they going to do with this? Because the project is done. They transfer it out. It could go to the debt service fund. It could go to the general fund. Okay. Here it's being transferred out, looks like, to the debt service fund. Why? Because this is the fund that's going to pay for all the principal and interest. Notice what happens once the construction project is completed. Construction work in progress is now eliminated, close to a building account, a real asset account. Notice that construction work in progress had a debit balance, so we credited it and we debit the building account itself. So let me just